with our session on expectations from the Indian market 2020. For this panel, I'd like to now call on stage Mr. Bharat Shah, Executive Director, Ask Group. Mr. Bharat Shah has over 24 years of experience in the field of investment management and has previously worked at Birla Capital International AMC Limited and Asian Paints Limited. He holds a bachelor's degree in commerce from the University of Bombay and is a postgraduate diploma in management from IIM Calcutta. He's also a member of the Institute of Chartered Accountants of India and a member of the Institute of Cost and Works Accountants of India. Can I call on stage Mr. Bharat Shah? Next, I'd like to call on stage Mr. S. Krishna Kumar, Head Equities, Sundaram Asset Management Company. He is the Head of Equities at Sundaram Asset Management Company with 22 years of experience, of which 16 years are in the equity market. He is a BE from Regional Engineering College, Trichy, and a PG DBA from Liba, Chennai. Can I kindly call Mr. Krishna Kumar on stage? Next, I'd like to call Mr. Anup Bhaskar, Head Equity, IDFC Asset Management Company Limited. He has an experience spanning over 27 years in the mutual fund industry. He has been associated with IDFC AMC since February 2016, holding a master's in business administration, finance, and a bachelor's degree in commerce with honors. Mr. Anup Bhaskar, can I request you on stage, please? This session will be moderated by Mr. Aditya Narain, Head Research, Institutional Equities, Edelweiss Securities. Aditya, with over 25 years of experience in the equity markets, is the Head of Equity Research at Edelweiss and India Equity Strategist. In his previous roles at global financial institutions, he has been a banking and financial sector analyst, Indian Equity Strategist, and Head of Research. Aditya has an MBA from FMS Delhi. Can I call on stage Aditya, please?
Welcome back from tea, and hopefully you all had a very, very interesting first half of the day. We now go into more brass tacks, more specific stuff, and this is a session that is focused fairly directly as far as the market is concerned, both in terms of what one can expect of it, what are some of the issues, and what are the things to look out for. For those of you who are familiar with the investment market, and I'm sure most of you are very familiar, this is also the time of the year when a lot of brokerages, a lot of fund houses put out expectations for the next year. You'll have notes titled Outlook 2020, or this is what will happen to the market, or this is the index target that you should effectively look at. So what I think we're going to try and do with this session is maybe just preempt some of that. It's still the first week of December, and we have very senior market experts, participants here, and we could probably set the ball rolling with this session with asking Anup in terms of what his outlook for the market is, what are the themes he thinks could play through, and how investors should kind of position themselves.
Hi. I know this is the time for a 2-minute Maggie, but this is straight to the chase, so there is no preamble to it. So I think we've had 2 years which have been very different from the previous 2 years. So 2016-17 and 2018-19 have been very different. And 2018-19 has given more pain to most investors as compared to the brief pleasure of 2016-17. So when we look at 2020 going ahead, the biggest worry is that will we have the same of 2019, or will it turn this time? So I think there are a few things that have, so if we first try to analyze where we are in 2019 and why we have reached where we are, it'll be better for us to get that right before we make any kind of assumptions or leap for 2020. So I think if if we had started in 2019, go back in Jan 2019, most market experts' view was that if we have a repeat of BJP government post-elections, then the market will revive. So we had a repeat of BJP government, but markets haven't revived. Then we were told that if you have some big reform, market will revive. So we had corporate tax cut at the end of August. Market went up for 4 days. Again, market has come off from there. So over the last 2 years, markets have been very polarized. Companies and sectors where earnings growth visibility has been strong have been rewarded, according to me, disproportionately, according to those who own those stocks justifiably. And anything which had a business risk, either related due to economy or due to management failure, has been punished very badly. So in 2018, BSE 500, 500 stocks, 108 were positive. In 2019 till now, that list has increased to 187 out of 500, but still almost 55% of the stocks in BSE 500 are still negative. So if you look at the perspective where we are, we've seen the Nifty move up for 2 years, and we've seen the mid cap and the small cap index give negative return for 2 years. And the gap between the two is now one of the widest and is actually comparable to what was there in 2008. So long story short, I think so everyone is hoping that 2020 will see a revival of the broader market, like what we have seen in the Nifty or on the or in the top 10, 15 stocks of the Nifty, which was visible in 2007-18. So that's the first expectation or hope everyone has. And largely this hope comes from valuation gap, which you are seeing today in the broader market versus the 70 stocks. So if you look at the BSE 100, there are only 34 stocks which are positive, the rest 66 are negative. So this gap in valuation between the winners and the ones which have been held back has widened, and therefore there is this hope that valuation will be a big factor to drive. I think so in any market move or any market cycle to change, you first need sentiments to change, you need a gush of liquidity, and you need the support of valuation for people to feel positive about the segment which has not done well for the previous few quarters or years. So when you see this framework, I think the sentiment will be provided by the government if they come out and follow up with the reforms that they announced in August end, with more reforms on the personal taxation side or on the capital gains side. Then you need RBI to work on liquidity, for liquidity to improve, because banking sector has shrunk its lending very dramatically in the last 9 months as such, and the lack of liquidity in the system has been one of the biggest factors that we are not seeing enough lending. What we have seen today in the case of RBL Bank, which was able to raise QIP money, if Yes Bank is able to raise money next week, then we'll start seeing the first signs of growth capital coming back, which will be the big factor for liquidity to have improved from what it was 6 months or 9 months away. And I think the fundamentals will be the last to follow. So if you look at the sequence of 2020, it will start with sentiments, it will be boosted by liquidity, and then there has to be a follow-up in terms of fundamental by the second half of 2020 for all this to showcase to us, you know, that the broader market has turned around and will, and then there we'll see actually positive returns from the broader market. So very long answer, I'm sorry for your initial question.
You know, very explorative, and I think part of the objective of this panel is to really think through issues, think through possibilities, because I think those days of putting a stock target price or a market target price, those days are waning a little bit, given in terms of the number of elements and influences that there are in the market. KK, maybe I can shift the same question to you two in terms of how you are looking at the market and what are the themes that you think one should focus on.
Yeah. Hi, good evening. I think Anup summed it up so nicely in terms of what's happened in the last 2 to 4 years and what's the kind of changes that one can expect into the next 12 months to 24 months. I think we expect to see a year of 2020 which could be a little bit more moderate in terms of performance on indices like Nifty or a BSE 100, which would be more of the large cap oriented indices. We've seen that there's been a fair bit of outperformance on some of these indices compared to the broader markets. Like, for example, Nifty is up 15% from December 17, while mid-cap indices are down about 20%, the small-cap index down about 40% in the last 2 years. So I think this kind of disproportionate value destruction in the broader segments of the market, I think will reverse if some of the things that Anup talked about do come true. And we are seeing that the global environment has changed a lot more positive for some of the emerging markets, and we do see that the global factors are a lot more favorable to a country like India, and the liquidity from offshore is going to be something that we look forward to support markets. Also, on the domestic front, I think if you look at most of the measures taken by the government, which have a longer-term bearing on improvement of growth, etc., and resolving problems of NBFCs and real estate, etc., these will play out, into the next 12, 24 months, and we will see recovery across broader segments of the economy, which will again get reflected through performance in stocks across various sectors. So this narrowness of the rally that we have seen, even in the large cap, is bound to kind of, moderate. We do expect to see a larger performance coming in, participation in the performance coming in from the large caps also across sectors. And also we see that as the fundamentals improve in the economy, the rally in the market spreads to a wider basket of mid caps and small caps over the next 12 months. So we believe that investors would do well as they position themselves by taking a little bit more exposure towards the middle and the lower end of the cap curve from where they are at this point today. As far as themes are concerned, we all talk about consumption, investment cycle, and financials. But broadly, I think if you look at what's happening in the last 2 months also, there is a lot of catch-up that is happening across beaten down sectors. That if you take pharma or take telecom or some of the banks or the SOEs also, there's been a broader participation that is starting to come in. So we see that this is the initial phase of more dispersed and diversified rally that we'll have in the market. So across sectors, I think stock pickers will have a good, good day over the next 2 years. I think one would be able to see that investment houses and fund managers who've been able to bring out bottom-up ideas, etc., would probably have a better, show than what's happened in the last 2 years of a concentrated rally. So I think I expect a more diversified rally across markets.
Thanks, KK. Bharat, maybe your thoughts on the same themes.
I hope the voice is clear at the back. Is it getting through at the back? Is the voice getting at the back? Well, there were 3-4 things that you asked. One, what is the outlook of the market? I have none. I never had one in the past, nor I have one today, nor is it likely that I'll have any outlook in future as well. I definitely believe that generality of the markets and attempt to judge it is so embedded in investing process and investing mindset that it really confuses and takes us away from the objective, which is to find good businesses run by good people and buying them at sensible prices. That is the task as investor. And how do I make a prediction about a market of some 6,000 names? Most of them rubbish, very little of any strength and semblance of quality, and a sufficiently large chunk of mediocre and average businesses. It's like trying to make an opinion on apple and orange and watermelon and melon and grapes and everything thrown together. And trying to make one opinion out of adding up all of them is an utter act of self-deception, is how I look at it. Second, your view was what are the themes?
Any themes that you
Yeah,
think?
so that's what I was saying. Second that you asked was about themes. And my answer is similar as the first one. Once again, we deceive ourselves by trying to ride on a theme or a trend or a fashion or some kind of a swing that we think will sail the boat and will take us ahead. When we try to ride a theme or a fashion, we float on the generality of an idea rather than specificity and picking and choosing and evaluating at a micro level what we need to do. Therefore, our laziness of macro thinking allows us to hide the hard work that we need to do to choose and pick micros. So while this is not to say that there are no long-term themes and trends and changes which are brewing, but understanding of a theme as a generality needs to be married, and rather that needs to be a background, while specificity of a micro and its merit or otherwise and its price or the value are really the questions that we need to contend with. So I really have no light to throw on what kind of themes can prevail. Like Buffett once said, when you hear enough of the forecasts, it reveals more about the forecasters rather than the forecasts themselves. And I think there is a lot of grain of truth about these attempt at making some bombastic prophecies and predictions about the future. Third was about mid-cap and large cap and small cap. And I'm sorry, but my answer is again similar. You are buying a business for its merits, whether it is run by a good guy or a thoroughbred rascal, whether the business is what it takes to create value or it will destroy the value, whether business is a large enough size of opportunity, whether it will grow, whether the growth will be meaningful and durable, and whether the quality of growth is right. We need to combine all of that into mathematics of understanding the value, keep revising as we go along, and have a discipline to buy it at a margin of safety. I mean, mid-cap or large cap is a statement of fact, what has occurred yesterday or today. The statement of size is a statement of fact, while markets are all about conjecture of the future. Therefore, when we try to make conjectures based on what is a statement of fact, we are really confusing ourselves. Mid-cap and large cap is an outcome that will happen if the process is right. But trying to derive a meaning out of an outcome and say what is the purity of the process is an utter confusion to my mind. So once again, there are enough thuggish companies and thuggish businesses in large cap, and so are in the mid cap, and so are in the small cap, and then there are sliver of some ray of hope and good businesses and good managements in small size businesses, mid size, and the large ones. So for all of the questions that you raise, my simple answer would be that investing is the hard work of the micro rather than floating into the generality of the macros.
And just on that, in terms of the specifics of the micro, do you think some of the dislocations you've seen in growth, right, and in stock values, which means individual prices, do you think this is the kind of setup where it has thrown up more opportunities within the framework within which you look at stocks, which is quality business, reasonable price? Do you think the dislocation in the economy and growth rate coming down to sub 5% to some extent is a little bit of a dislocation? Do you think it is throwing up more opportunities in this? Would you be tempted by seeing businesses that are fundamentally the same that they were a year and a half back but are cheaper? Or the other way, which is businesses have got stronger because some of their competition has eroded because of these challenges?
Well, 3-4 things. One, opinions of the economists and the journalists and many other bystanders who constantly keep making some day-to-day kind of predictions about the situation, all of them are characterized by two important attributes. All of these opinions are more a postmortem of a history which has occurred, and the comments are made today. While markets are trying to dwell into the future, conjecture and judge that future, discount that back to the present, back their money where their mouth is, and then really kind of deal with that uncertainty of the future. When we juxtapose the slowdown of economy and all the pink media headlines and electronic digital media headlines suggesting as if markets have gone nuts and here is a slowing economy and here is the highest, roughly the point of the market, and then we breathlessly analyze so many threads within that. While, of course, at a headline level, that will sound like an utter oxymoron of a term that economy is at relatively one of the low points in terms of the growth rate, while markets are relatively at one of the high points in its history so far. But the confusion comes because markets are dwelling into the future, and economists and journalists and other bystanders and observers are really dealing with the postmortem of the past. Second, market is a place where real money is being put. So they better be right, otherwise they'll quickly part with their money. Economists and journalists do not have such an ardent responsibility on their words that they have to really back it up with the money and be accountable. So I would in general be more trustful of that work that somebody is doing and believing and putting their money. They better be right. This is not to say that markets are never wrong. Markets are utterly stupid and foolish at various points of time. But if I have to make some kind of a conjecture about the shape of the things where it is, I think markets are trying to reflect into the future, and markets are believing that whatever has to happen has happened, and it is kind of trying to grapple with the future that it is forecasting. And it is backing it up with the money. And in all probability, as I see it, probably markets are, broadly speaking, in a right frame of mind in terms of what they are doing. Secondly, the dislocations that you talked about. Much like in a business, in an economy, it is not a straight line upward sloping curve in a very smooth, evened out kind of a curve. That in a very predictable, monolithic, almost mechanical kind of a growth rate at which it will keep growing over a long period of time. Economy, much like businesses, much like individuals, have their moods, quirks, temperament, and some oddities, and therefore these quirks do get reflected in occasional period where these will reflect into the kind of quirky and temperamental growth rate that we have seen. The key point is whether it is structural and very, very long period of time, it is how it will remain, or it is tactical and temporary. I'm not an economist, and I'm glad for that. So I'll not like to make that kind of a prediction. I think the duty on me as an investor is still to find businesses which are going to deal with this situation, will find a meaningful growth. The growth has to be qualitatively sound, and I have to reflect on the equation, which is finally the mathematics, as to whether all that conjecture is adequately represented or leaves a margin of safety. That equation, to my mind, remains important rather than trying to find these quirks or oddities or temperamental behavior and trying to analyze too much into it. But that having said, I'll make one final point. What economy is going through is a process of a bit of a transformation. The process, if I have to describe for want of anything else, I would say creative destruction. The rotten and the rubbish and the mediocrity is getting annihilated, killed and decimated so that the good thing has a space to flower and nurture and grow. And that is the way it should be. Some of the most important reforms that have occurred in economy are all aimed at cleaning up the muck that we have accumulated as a country, as an economy, as a society for a long period of time. Demonetization, which is an attempt to clean up behavior of individuals. People don't like it, may or may not like it, but it is important enough shock that has been produced so that people better have some fear in terms of their behavior as it has been all this time. GST is seeking to do the same thing, that businesses where only advantage was tax arbitrage, which is a euphemism for cheating and evasion, really that kind of advantage is going to get negated over probably 5 or 10 years' time, and that will clean up a lot of rubbish businesses out of the stables. Similarly, Insolvency Bankruptcy Act is finally ensuring that a lot of people, so-called large industrialists and promoters who were able to get away with all that shenanigans, finally are made accountable and they have to lose assets or worse. And the similar thing for cleaning up of the muck on the bank balance sheet. For a long period of time, this rubbish was accumulated. Unless and until you clean up and therefore slow down your growth rate till you clean up so that you get back more healthy and grow properly over a period of time, you couldn't have dealt with this situation. And RERA is doing similar thing in the real estate, the largest segment of the society, of the economy, but one of the most muddled and kind of convoluted ones. Reforms is not an easy business. All of these will cause some pain, some difficulty, some slowdown for some length of time. We better accept it and live with it, but it is all for eventual good. And therefore, I would say this creative destruction is actually healthy. And in the process, mediocre and rubbish businesses or businessmen die. That is not something to shed tear at, but that is a matter of celebration.
Thanks. Anup, how would you look at, as Bharat said, the market is looking at the future and is discounting some of that.
Do you think I want to answer that question afterwards?
No, I would just, I think that's one part of it. I think the other part of it is if the market is a little bit more optimistic than the historic economic performance, right, given that one is forward-looking, one is backward-looking. If you were to position your portfolio, right, which are the areas that you would think you would want to be in?
So I think so in every economic slowdown, though Bharat Bhai doesn't believe in macro, but my view is that in any economic slowdown, in every industry, the leaders tend to benefit because the consumers who are left are the ones who are not going to go and buy it on credit. They're the ones who have cash, who have and the numbers keep falling of such kind of customers. So today, or for the last 9 months, there has been this battle of trying to buy great companies without looking at valuations and saying, I am willing to take a valuation risk because with all due respect, what Bharat Bhai says, I don't think so. The valuations of a lot of these companies are justified, but because they have earning certainty for the near term, everyone is willing to go and crowd into those companies. And then there is this other set of companies which have a business risk. They may not be as rubbish or as bad as a general sweep of paint, which is being painted on them, but they have blemishes. Today, for career risk, if you don't want to have career risk, it's better to buy a company which has got certainty of 15% earnings growth at 70 PE, because that's where your career will survive. But if you buy a company which trades at 0.8 time book, historical ROE has been 13%, which has now dropped to 8%, you will like to pass it because the next 2 quarters could be worse. So I think that's where and there is no right or wrong. There is a market and there is a clientele for people who want to buy great companies, hold them for 15 years, and get the compounding impact. And then there is the rest of us who want to buy at the right price, even if it is shit quality, because if you buy shit at the right price, I think you can still make money. Unfortunately, that trade hasn't worked in the last 18 months, so we look exposed and look totally naked in front of those who are buying great quality. But it's a cycle. Hindustan Lever for 10 years did not give any returns. It was a great company then, it's a great company even today. And for 10 years, it has been the best performing stock. So I am very confused when people talk of quality, because I can give you numbers. These days, my memory is not very good. Of two companies which over a period of 10 years have had the same sales growth, same growth in EBITDA, same growth in PAT. In fact, ROE of one company is higher than the other. But the return difference is actually 110% over 10 years versus 1,453%. I will not say that company A is great and company B is rubbish, but that is how the market has voted, that if you are in the right sector, so for example, specialty chemical, every analyst believes that they can forecast how specialty chemicals will play out for the next 5 years. And therefore, every specialty chemical company trades at a trailing P of 35 times with a forward earning growth of 30% for the next 5 years baked in. I don't know whether that is right, wrong, and maybe it's sour grapes. So my advice to all of you is that we don't know which cycle will work all the time. And there is no cycle, believe me, which works all the time. Only the perceptions change of what is good and what is not good. So you should put your portfolio in a way that you are in both the camps, because, or you should not feel bad that that if you have a year like 2016-17 when all the things which were not the highest quality did very well, then you should not come chasing after 2 years to buy that. So you be in whichever camp you want to be. There is no right or wrong. See, like religion, you have different religions with different thought process. The aim is to give you peace of mind and to help you, during trouble time. Same way, there is no one investment philosophy which is the philosophy that you have to follow. He is most comfortable buying quality, Bharat bhai, and he's done a very good job. That's his forte. I think so. Buying the right price matters, as much as buying the right quality. And there will be times when I'll get whacked, and there will be some times when he will be behind. His will be a time correction. In my case, there will be a price correction. But what falls also a lot also has the potential to go up as fast as possible, as it has fallen. So I am not in the camp that, one is right and other is wrong. You should figure out, what suits your temperament and how do you want to put your portfolio in which strategy.
I think Anup made some many valuable points, and there are 2 points on which I'll put a little bit of clarification. On one point, I have a disagreement, and on 2 other points, I have agreement. So let me very quickly deal with each one of them. The clarification, I'm not saying macros are to be dismissed or they are irrelevant. I'm saying within the generality and broadness and haze of the macros, you have to find the truth and the clarity of a micro. That is the job. If we let our minds be too covered with the macro, then we lose the perspective and the specificity of a micro, because ultimately you are buying a particular business. You're not buying what Mr. Trump says or what Mr. Raghuram Rajan says at one point of time. That's not what is my investment thesis, right? Second, it can never be the case that good thing can be bought at any price. It will be utterly, utterly wrong to buy anything, however good it is, however great a business is, however great the capability of the management is. Ultimately, the constraints, the gravitational force that price and the value equation, the margin of safety implies, has to be honored and has to be respected. So if anybody is trying to buy anything at any price, then I think there is, again, a generality of an idea rather than specificity of the mathematics. Quality and all other aspects are the English part. Finally, that English must subsume into the mathematics of that price margin, price value equation or the margin of safety. Getting away from that is a very dangerous play to be made. On the part where I disagree with what is stated, that everything has a price, that even rubbish has a price, maybe, but philosophically, temperamentally, and I would say empirically, if we study the history of rubbish, which is galore, because by definition, 90% or more of the companies either are rubbish or mediocre or even worse. And therefore, there is enough examples to study and check out. And over a period of time, both the good and bad things have volatility. It's not as if good things go through a very nice upward sloping curve, but both good and bad acquire a volatility. Only difference is good will move through volatility in an upward rising curve. The bad also will have volatility, but of a curve which is sloping downward from the left to the right. And therefore, any attempt to profit out of a bad business is a fairly dangerous activity. You have to get right both your purchase price, you have to get your exit price right, and in between the phase, you have to be favored son of the god. All three have to combine for you to profit out of that activity, is how I view it. But I fully reckon and respect that while there are more than one ways to reach Makkah, but if we think that there are 20-lane highway of reaching, probably that also is unlikely to be proven empirically. It is not a road where there are 20 lanes and you can drive a Ferrari. It is a road with twists and turns, and it's a narrow road. We have to follow the rules and regulations, and we have to follow the discipline of driving right to reach destination well and in one piece. Otherwise, accidents are quite likely. Then there were the two other points where I agree. The point about temperament, what he mentioned, I think it is an utterly important point. More than any other ability, it is temperament which is the most important part. And while intellect is required, but we shouldn't overplay the role of intellect. Ultimately, temperament, discipline, and wisdom of understanding beyond numbers is something extremely critical. And therefore, the temperament of what that individual is, and to evolve a style and a method where in a comfortable body is living comfortable, or rather soul is living in that body comfortably so that there are no mishaps occurring, is something very, very important. And temperament is a key idea which drives that.
KK, I'd like to bring you in on, one of the themes that's been running over the last 6 to 12 months is the role of the government, or the lack of the role of the government, right? Which is, how much of a villain is it? How much of a hero is it going to be in terms of the recovery? So from your perspective, just looking out, given that we've actually had a fair amount of government action in the more recent past combined with what the RBI has done, in your perspective, what are the things that probably need to be done? Does the government have a role, or you're just back to a normal economic cycle where there's been some stimulus, there's been liquidity put into the system, and now things will recover on their own? Or do you think there is more intervention that is effectively required? And is that intervention needed both for the economy and for the market, or just one of the two?
So I think, while longer-term economic cycles will play, but the government has a very key role in shaping the longevity of a cycle, and in terms of controlling, the kind of long-term growth that you would want to achieve, along with its own targeted monetary stance, which is done through the RBI. Also, in terms of what kind of other metrics that you want the economy to go through, in terms of inflation, in terms of wage growth, etc., and also in terms of uh, guiding the economy in terms of the longer term path of whether you would probably look at it more from a service sector, led growth, or would you want to have an economy which is more manufacturing led? So, I think the government's role is very clearly there in terms of trying to put emphasis on which part of the economy is where they're driving and how they are able to also bring in the social angle in terms of job creation and demographic dividend playing out for the country. So here, I think the government, in the more recency, I think has become a lot more attentive to the needs of the economy, attentive to listening to the various participants, be it the industry, be it the investment professionals, or be it the economists. I think there is a lot of think tank which is working behind, which is helping the government to also reformulate policies and targeted action that they have been taking. But I guess, a lot of these things are a little behind the timeline, so we have slipped into this kind of a growth, soft growth. Otherwise, we could have been better off, over the last 12 months. Having said that, I think there are 2-3 areas that we would like the government to probably work on is trying to, generate resources to help the fisc by broadening the revenue streams, and also it will also through a public PSU divestment, as you broadly call it. If you look at more strategic sales of PSU companies, you would get a lot of capital and revenue into the budgets, and this has a lot of potential to be used elsewhere for their long-term infra investments and growth that the country is looking up to, which will create a lot of jobs. It will have a ripple effect across the economy or a longer term. So I think we need to see accelerated PSU divestment, which will should be a key point of this of this term, which will really help take things forward. The other measures taken by the government on taxation is very welcome, but I think along with that, you need to create a better environment on labor, which is again something that is, people are looking forward for the legislation that is ongoing. So these things would definitely be something that we would look forward to push longer term, growth.
Thank you. One of the lovely things of the market, and that's what makes it so interesting, is that there are varying participants with very different thought processes and ideologies. And I think that's what makes it both the challenge and the very interesting play that the market is. We'd like to open this up for Q&As. So, we have very established investors here. So we'd love you to put your hands up, ask for the mic, and throw reasonably difficult questions. I'll just get a mic. If a mic can be brought to this gentleman in front. Maybe if you could just be a little loud then.
So I appreciate the point, I think, which was made by Bharat, that you're talking about the fact of a slow economy right now, and you're trying to marry that with a conjecture about the future. But having said that, the concern that we have is that we are probably set for a structural slowdown of the economy, right, with many things not in place. And while this can be buoyed up by props like, giving you a relief on capital gains tax or distribution, dividend distribution, and so on and so forth, the fundamental problems of the economy, that it is not globally competitive, that there has not have been enough of reforms in key inputs like land and labor, and this is likely to remain so. So what we are trying to struggle with is the contradiction between still a reasonably buoyant market and a reasonably pessimistic outlook on the economy in structural terms. So that's the contradiction that we are trying to resolve within ourselves, and I was just wondering as to what does the panel think about this contradiction.
Maybe Anup, we could start with Anup.
I think so. Again, when I started my comment, I said that for any market change to happen or new market cycle to happen, you need a change in sentiment, you need a gush of liquidity, you need the support of valuations to be modest. And then actually fundamentals follow after that. Unfortunately, the professional, if you look at our industry, whether it's mutual fund or PMS, we are always bullish. We are always saying every time is a good time to buy for whatever reasons. But the point is that what the market today is trying to forecast or trying to depict is that there is a greater possibility of strong government action which can change sentiments. Globally, there have been surveys which come out regularly, which show that the cash levels of global equity funds now are at a lowest level compared to what they were 3 months back when there was worry that things could go worse. So if you see, there is some bit of a risk on bet which is going on. US is up 25% this year. Even markets like Europe are seeing some bit of uptick because they are probably very cheap compared to US. India in dollar terms is up. If you look at the Sensex or the Nifty is up 9% or so. So I think so. One is globally the worry that actually US central bank will keep on tightening has now eased up a little bit compared to last year. If you remember, between October to December of 2018, the markets crashed in US and we were at the edge of a bear market because the markets had fallen almost 20% because they had 4 or 5 rate hikes in a row. They've had now 3 rate cuts and the view is that at least rates will be held. Plus, again, in terms of the balance sheet of the US central bank has, now expanded once again after, contracting for the last 2 years. So there is a lot of liquidity which has led to a more risk-on, environment in the US. Hope is at some point of time it will flow into emerging markets because emerging markets are cheaper than US. Excluding India, India trades at a 70% premium to the case of emerging markets. In India's case specifically, the big hope is that the sentiment could be changed by government making announcements. Equity is always forward-looking, debt is always backward-looking. So debt today was very worried in terms of what will happen for the next 6 months, whereas in equity, the view is that the worst in terms of GDP print is probably behind us with the second quarter, and third quarter will probably see some improvement. And on that, we will build up in the next few quarters. So, which is where there is a dichotomy that when you look at this Nifty and when you look at the economic condition, there is a big gap that you see as an investor. And what the market is trying to depict, or what you can read, is that the market is hoping that this slowdown in the economy has probably seen its worst and will now improve going forwards over the next 2 to 3 quarters. If I'm not mistaken, that's...
Maybe
add on,
I don't know, maybe you can take any other questions. We can rotate questions around if there are. There's one at the back there, if the mic can be moved there. You'll be surprised, but we can hear you.
Technology is, how industries are embracing technology. So as in the investment management industry, how are we seeing technology to make our day-to-day lives easier to evaluate businesses? And are we seeing any impact in India, considering that all over the world, this whole talk about passive investing is coming in, the alpha is going to disappear, et cetera, et cetera?
I'll hand that to Bharat Bhai, but before that, I must say, you must distinguish between the investment advisory business, which is ours, which what we do is we keep writing more and more reports, however wrong they are. I'll leave it to the investment managers to give their views on how they look at it.
Technology is a tool. It's a means to an end and not an end in itself. And therefore, we shouldn't get carried away by however powerful and disruptive impact at a point of time technology may seemingly pose. If you if you reflect on that seminal work some 50, 60 years back or thereabouts, maybe 40 years back, a work called Future Shock by a person called Alvin Toffler, where how changes are accelerating at every point of time. And at a point of time when we are living in the midst of that change, it looks as if it is the highest and the foremost. But every generation, every over centuries has gone through their moments of their acceleration, where it looks like the changes are far more than what they've been accustomed to up to that point of time. Of course, the pace of acceleration clearly has accelerated with the technology. There is no doubt about it. So from the agrarian revolution 350 years back to the industrial revolution 1 to the industrial revolution 2, and then information technology revolution in the 70s, and now the digital revolution. And many more things would come, like which is brewing in the environment. But at the end of the day, technology is a servant. It is not an end in itself, it's a means to an end. The role of technology in the investing so far, still, for example, if you look at the game of chess, and it has been increasingly found that it is very, very hard to beat a very powerful algorithm of the chess which has been developed. So even people like Kasparov, after winning initially, finally had to surrender and couldn't fight. A game called Go, which is the Chinese game with infinite kind of combination and permutations. So extremely, extremely difficult for some to arrive at very clearly spelled out algorithms. But some of the best Go players have admitted that it is increasingly impossible to fight against the power of the algorithm which is there. But if you look at carefully, chess and games like Go are more matters of skill and intellect. And the games and the arenas where the role of the wisdom, sentiments, understanding the psychology, etc. are also involved. So-called English compared to the mathematics that I talked about, then the picture becomes more fuzzy. And therefore, at least in the foreseeable future, I believe, unless and until we are talking of very mechanical kind of investment construct, the role of technology to be able to obviate the role of the human capability in that is going to be very limited. So robo-advisory and other stuff has come by, but it's more at a mundane level and more at a mechanical level. It will get better over a period of time and get more improved. But in the games where the role of the human skill, sentiments, not just intellect, but larger issues than intellect are involved, it is harder and harder for it to be beaten. You might be aware of LTCM, Long-Term Capital Management, the firm which came about like a blazing star in early 90s. The firm had some 70, 80 PhD stalwarts working in the firm. It had 4 Nobel laureates with huge amount of capability and intellect behind it. It did extremely well for a couple of years. The whole model was developing some very powerful algorithms, trying to find small, tiny amounts of imperfection in the market and spot them early, magnify the advantage by putting brute force behind it, and making gains. It worked for a couple of years. Then in one blazing fortnight, the whole firm went belly up and became a Chapter 11 firm. So I believe that understanding of that psychology, understanding of what makes businesses work and what can make it fail, beyond just the immediacy of the numbers, is a very critical capability one needs to develop for one to be able to remain on the top of the curve. Changes will keep happening. Sometimes changes will accelerate. Sometimes they'll look dramatic and drowning ones. ultimately investors will have to have wherewithal and peace and calm of the mind to be able to deal with the changes, figure out what are the noisy social media kind of changes and what are the real long-term kind of changes, and make the game appropriately scaled and skilled continuously in sync with that.
We'll take one last quick question.
My question is very simple to all three panelists. Which industry will do best in the next 12 months and which industry will do worst?
So it's the simple questions which are most difficult to answer. It's the simple questions which are most difficult to answer. So,
God can answer that. My view on that is again simple, that moment we try to say that something is a certitude and an affirmation and a guarantee that something will happen like this over a 10 and 15 years time, then we are likely to slip our watch, reduce our guard, reduce our hard work to find out on an ongoing basis the real factors which will determine success and failure, and we tend to ride in the generality of that train. Therein the risk lies. Even in the great businesses and powerful and the most honest managements, for example, a company in a consumer firm which I own personally for 28 years and I have not yet sold, but you still have to watch, you still have to judge, you still have to figure out whether things are what they look like and what you believed. You check, you trust, but you verify. You trust and verify is an implicit responsibility cast upon you, even if you remain with it for a very, very long period of time. That nothing is so general that you can ride for a very long period of time. And everything requires the thesis and the underlying attributes which will create value and will keep creating it. They need to be watched all the time. So I would hesitate to give the generality of some sectors which will do very well. But since you are asking, I would say probably insurance is one industry where penetration rate is low and opportunity is large. Growth of the per capita income is a natural favorable factor in that industry. And therefore, broadly, there is a case that something worthwhile should come out of that industry if we are careful. Likewise, there are many other businesses. Consumption is one, where I would say till it becomes 5 times or 10 times what it is, probably we have not exhausted enough of it. This country is aspirational. Every rise in income will lead a greater amount of consumption than before as a percentage. Therefore, rate of consumption will grow at a rate faster than the rate of income is my belief. And therefore, there is a large size of opportunity. But still, we have to find good businesses running their activities well, have a large size of opportunity, and that people whom we can trust and the valuation which is making sense. All of these still remain the responsibility.
And KK will have the last word.
So I think, while all of us try to buy the best businesses at the right price, with the best managements, jury is out in the long run what finally the results turn out to be. But to answer your question, I think, the next 1 year, I think some of the segments that we remain positive or on auto components, I think they've had a pretty bad time and we see a very good recovery over the next 12, 24 months there. Again, I think the much talked about investment cycle, at some point we do expect good improvement. So engineering cap goods, again, something which is very underinvested and has a lot of potential in the next 12, 24 months. Third, I think, is related to capital markets. I think anything to do with capital markets will do well because, markets are doing well and we will see a lot of capital raise and a lot of wealth created. So businesses around capital markets will also be something one should bet on.
Thanks.
I think as an economy, if you expect improvement in growth overall, I think there will be a relative underperformance of some areas, but I don't think anything is going to fare very badly. You know, you are going to see general all-round growth happening. So I think you will have a upward bias with relative underperformance of some sectors. That's it. It's not going to be a big negative return, or that's not the expectation.
Okay. We'll have to close. We have another couple of panels coming up. Some of the panelists will be available for short conversations. But, I hope you've got some answer. I hope you've got some answers. I hope you've got many more perspectives. And I'd like to thank all the three panelists for this very extensive interaction. Thank you.